What if I told you a single number just sent shockwaves through the world's biggest economy? This is Kenya News Update today. Coming up, you'll discover why a tiny manufacturing uptick is causing a market meltdown across Asia and what it means for your investments. Meet the rating dog China General Manufacturing PMI. It's a boring name for a number that just moved billions. In January, it ticked up to 50.3. That's barely above the line that separates growth from recession. But here's the twist. This microscopic gain is the strongest signal China's factories have sent since October, and it's happening as the world holds its breath. For 9 years, China has been the engine of global growth, but that engine is sputtering. A new study from Oliver Wyman found that 22% of affluent Chinese were negative about the economy in May. That's worse than the 21% right before they ditched zero COVID. The hope was that factories would roar back to life. Instead, we got a whisper, and the markets heard it loud and clear. Asia-Pacific markets traded mixed in a chaotic Monday session. Japan's Nikkei 225 inched up 0.13%, but South Korea's Kospi plunged over 2.5%. Hong Kong's Hang Seng Index dropped 1.64%. Australia's S&P ASX 200 fell 1%. It's a tale of two continents reacting to one confusing signal. But here's what nobody's talking about. The real story isn't in the stock markets, it's in the metals. Silver prices, which had more than doubled in a year, plunged around 30% last Friday. That's the metal's worst one-day crash since 1980. Gold also dropped around 9%. Spot gold was trading 5% lower at $4,612 per ounce. Silver slid around 4% to 81.189. This isn't just a correction. This is a panic. Investors are dumping safe haven assets because a weak China recovery means less global demand for everything. The PMI reading of 50.3 was exactly what analysts expected, yet it triggered this volatility. Why? Because expectations were for a boom, not a whimper. Manufacturers accelerated production to load cargoes ahead of the Lunar New Year holiday. It's a seasonal bump, not a structural recovery, and the smart money knows it. So, what does this mean for you, watching from Kenya? If you have any money in global funds, Asian stocks, or even just follow commodity prices, this ripple is coming. A shaky China means less demand for our exports from tea to flowers. It means more uncertainty for the shilling. Some say this is just a blip. Others say it's the first crack in a dam. But here's the part that will blow your mind. The strongest manufacturing data in months couldn't stop a sell-off. That tells you everything about the fear in the room. The stakes, your portfolio, your business, the global economy hanging by a thread of a 0.2-point PMI increase. The controversy is clear. Is China back, or is this a dead cat bounce? Do you trust the data from Beijing? The implications are massive. If the world's factory floor is only just expanding, inflation fights get harder, interest rates stay higher, and growth everywhere slows. But if they're faking the strength, the collapse will be even worse. So, we're left with one unanswered question. Is 50.3 a sign of hope, or the last gasp before a much deeper fall? Do you think China's economy is recovering, or is this the calm before the storm? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking news that connects the global dots to your doorstep.